The only difference is that in the repo market, unlike the pawnbroking market, the pawnbroker, in this case Goldman Sachs, JP Morgan, and all the other guys, they will lend, they will give you like 20,000 for your iPhone, because they want to charge you interest on the 20,000, not just like $300. So it's crazy. And they're doing this for this basis trade. Tuesday, November 4th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, we're going to look at derivatives today, and we're going to look at the repo market and the basis trade, because I think there's trouble brewing in the financial system. And yes, there's been a lot of clues of late. And of course, the mainstream media will not cover this because it's such a specialized subject that their audience, like CNBC's audience, Bloomberg TV's audience, all they want to know is that the stock market is up, making new all-time highs, but the plumbing of Wall Street, that's in danger right now. But I need to explain to you what derivatives are, what kind of derivatives there are, and the repo market as well. Because, yeah, if you don't understand that, it's no point. And the reason I'm doing this is not so that you can become a specialist and participate in these markets, but it's for you to understand how leveraged and risky the system is, and how much worse things could be. So, a lot of you know my background. I was a futures and options broker for 20 years in the city of London. Futures and options are a kind of derivative. And what is a derivative? Well, academically and like used the right way, derivatives are a way to hedge your investments, or hedge your investments. So a derivative is just a side bet on an underlying asset. And they've been traded for hundreds of years. I mean, the Dutch had options on the price of tulips in the early 1600s. They're the ones who started it. And back in the 19th century, the major derivative or futures exchanges in the United States evolved in Chicago with farming and cattle. And the reason these derivatives were used was for producers and farmers, growers to hedge, to fix their price so that they could run their operation, fix their costs, and make sure they had a profit to keep running. So that's how the Chicago Board of Trade, the Chicago Mercantile Exchange were created. They were more for agricultural derivatives. And usually derivatives, though, allow you to hedge quite a big amount of exposure, and you're not forced to put 100% down of the value of the contract. Let's say it's a contract for cattle futures, $100,000 worth. You only need to put $5,000 or $10,000 down to hedge your exposure. So it's quite leveraged, but if it's done properly, if you're a real farmer, cattle rancher, and you want to hedge, it's all above board. But then you get what's called speculators, who come in. They know nothing about farming or anything. They just want to bet on the price, and they leverage everything. Yes, it's dangerous. Maybe you think, we should ban speculators, but speculators actually provide a service in that they provide liquidity for that market. So that's derivatives in a nutshell. And when it's traded on an exchange, it's called an exchange traded derivative. And that exchange is a public exchange, and it provides all the data, all the open interest, how many bets there are, who's doing what, and so on and so forth. So it's relatively self-regulated and transparent. So let's skip forward 100 years to 1980. So what happened in 1980? Well, it was kind of, started like in the 70s with the advent of the fiat dollar. When Nixon closed the gold window, the financial system became a lot more volatile. Bond prices fluctuated wildly. Currencies started to float against each other. So these exchanges in Chicago, they started developing derivatives contracts for these financial assets like currencies and bonds, interest rates, for the same reason, because investors had to hedge because things were really whacking out. There's no anchor of gold. And this is how it's evolved. But the derivatives market is supposed to be the tail of the dog, so to speak. But it's become so huge these days, and it's evolved, of course. Now we have something that evolved from the mid to late 80s called over-the-counter derivatives. They're not on exchanges. They're completely opaque and not transparent at all. And basically, it's, let's say a fund manager wants to hedge some kind of risk. He'll call Goldman Sachs, and Goldman Sachs will write a contract for them, derivatives contract, highly leveraged as well. And Goldman Sachs will usually fund that. You should watch The Big Short. That's what it's all about, that movie. So, yes, the OTC derivatives, that's the one you need to worry about. The exchange-traded derivatives, they can be risky, but they're public and people know what's going on. Like COMEX, gold and silver derivatives, they are public, and we know who the open interest and how many shorts and longs and the commercials, the speculators, right? But LBMA, for example, that's OTC. That's why they're in trouble this year, because they've created too much paper. That's a different topic, though. So back to the derivatives, the OTC. They mushroom now, the exchange-traded derivatives. And the bankers on Wall Street, City of London, Frankfurt, and Paris, they're in charge of all of this. Tokyo, all the big financial centers. And some people speculate that the notional amount of all these bets is over $1 quadrillion. And what's a quadrillion? Well, it's 1,000 trillion. Nobody really knows. And therein lies the problem. And the regulators, they know all about this. The Bank for International Settlements, who writes up the Basel rules for the too big to fail, they warned, and I've got the article here in the FT, they warned in September of 2023, hedge fund bets could spark turmoil in U.S. Treasuries. BIS warns. Short positions in 2-year Treasury futures reached record highs in August. And this is all to do with a derivatives called the basis trade, which is actually a derivative upon a derivative. It's highly leveraged. And I'm going to come to the repo market as well. But suffice it to say, they've been warning about this basis trade, which is basically trying to scalp the difference between the cash treasury bonds and the futures on those treasuries. And it's a really boring trade. When I was a futures and options broker, I traded these government bonds and treasury futures, and very few of my clients did these basis trades, but now it's a big thing with the hedge funds. And the other thing you need to know about derivatives, especially the financial ones, they're mushrooming and growing because our fiat currency system is it's grown so much. It's so much inflated, that bubble, that you need these kinds of instruments to keep things going. And that's where we are right now. So where does the repo market come in? Well, now that I've explained to you what derivatives are, and I would say the OTC derivatives are, they mushroom exchange traded derivatives, and bond and interest rate derivatives. They're like 2/3 of all derivatives, and other derivatives are like metal, commodity derivatives, precious metals, currency derivatives, stock market index derivatives, and I'm not even touching upon the derivatives that Wall Street has created for the retail investor. That's another topic, but that's not good either. All these 3x ETFs, short ETFs, inverse. This is all really bad. It's all based on leverage and risk. But now to the repo market. What's the repo market? Well, the easiest way for me to explain to you what the repo market is a pawnbroking shop. So basically, Wall Street, the big investment banks on Wall Street, City of London, other financial centers, they are primary dealers as well with the Federal Reserve. Federal Reserve helps them out, pumps them with liquidity when they need to, but they are the pawnbrokers, and all these speculators, hedge funds, fund managers, whatever, they come to them with their assets. Let's say like you go to a pawnbroker with your iPhone and you want to do a buyback. So you give your iPhone that's worth, let's say, $1,000. They'll give you like $300 for it. And then you come back in 28 days and you pay, let's say, $400 for it. And they make that profit. And that's the same thing with the repo. But it's usually done like every day, overnight, maybe weekly repo. You go back to buy back your treasury, your mortgage-backed security, or whatever you leave there as collateral. But the only difference is that in the repo market, unlike the pawnbroking market, the pawnbroker, in this case Goldman Sachs, JP Morgan, and all the other guys, they will lend. They will give you like $20,000 for your iPhone because they want to charge you interest on the $20,000, not just like $300. So it's crazy, and they're doing this for this basis trade. And I have to give Francis Hunt, the Market Sniper, and you should check his channel, the Market Sniper. He came on a couple of weeks ago and he pointed out to me that the Federal Reserve was perplexed recently because they realized that there's $1.8 trillion worth of treasuries in the Cayman Islands, a tiny little speck in the Caribbean that has a GDP of about $8 billion a year, controlling $1.8 trillion worth of treasuries, biggest foreign creditor of the United States. Well, it's not the Cayman Islands Teachers Fund that's buying all these treasuries. Well, it's the New York and London hedge funds that are legally based there, so they can put through these massively leveraged derivatives trades. And use, of course, they use the repo market. And so that's what's going on. There's even an article I spoke about, I think, the other day, that came out in the Neue Zürcher Zeitung, which is a respected Zurich, Switzerland newspaper, and it talks about this trade. So people are waking up to it, And as I said, the BIS warned about it back in, well, just over 2 years ago. So the BIS always seems to warn about these things, right? It's not that they want to stop people. It's just that they want to cover their back. So when this crisis erupts, and I think we could be close to this crisis erupting, they can say, well, we warned about it, right? That's the way they work, these people. And the last repo crisis, of course, was back in September 2019, and the Fed had to stop quantitative tightening and start QE again. They called it, oh, this is not really QE. And then a few months later in 2020, they flooded the market with trillions of dollars. And yes, they used the excuse of COVID, but I think that was just a cover. That was a massive bailout of Wall Street, in my opinion. And we could be on the cusp again of such a crisis. And, well, surprise, surprise, the Fed recently announced, or last week at their FOMC, that they're going to stop quantitative tightening. And some people actually think they've made a mistake there, because they're only going to stop from the beginning of December. And some people think they should have stopped right now. And I kind of agree. Not that I think it's a good thing that they start QE again, but yeah. So yeah, the repo market is basically the pawnbroking side of the financial system. It provides the grease for the system to run. So if there's a problem there, look out. And there has been problems the last couple of weeks, especially concerning these financial institutions having to use the Fed's special repo facility, which usually isn't used. The repo facility that's used is the market facility, the pawnbroking facility of the free market, so to speak. But that's kind of clogged up. And usually there's a problem when, let's say, Morgan Stanley or JP Morgan, Goldman Sachs, they do repo amongst themselves and for other financial institutions, and it shouldn't really be complicated. They take the treasuries, they lend the cash for a day, and then they reverse everything the next day. But when you don't trust counterparties, you stop doing that, and that's the bad signal. So there's a guy that I've interviewed, Just Dario, before, and he's been warning about this for the last few weeks. He's been following. He's been saying that this Fed repo facility has been used again, and it was used quite a big way last Friday, but that could have been related to end of the month accounting. But apparently yesterday they kept using it, which is a bad sign. He warned about that the banks borrowed another $7.5 billion from the Fed standing repo facility in the afternoon, and a total of $22 billion for yesterday. And it wasn't the end of the month yesterday, right? These repos are usually done amongst themselves, not with the Fed. So that's a bad sign. Dario is also warning about how the U.S. government shutdown could trigger a banking crisis because it's draining a lot of liquidity from the system. He warned that on October 31st. And now you have also Zero Hedge warning about it with an article from yesterday. All hell breaks loose in repo markets and why a historic melt-up could follow. Melt-up? Why? Well, because the Fed will have to step in and print trillions. The Fed, ECB, Bank of England, they're all going to do it. And the Achilles heel of this system is the leverage. Don't forget, because, yeah, these trades are all put on with borrowed money, and therein lies the problem. So it seems to be spilling over now into the stock market here this morning. It's 8 a.m. London as I speak, And we've got the Dow down 338 points. Yes, it's less than 1%, but the NASDAQ 100, though, is down 1.2%. So we need to keep an eye on this. And I've been told by the Gnome of Zurich, he does a lot of his Elliott wave analysis, the wave analysis. And he was telling me yesterday that the NYSE composite looks very bearish. And he thinks we could be in for a crash. I don't like to call crashes. It's very difficult to time things, but something's going on here. The other thing you need to keep an eye on is that treasury yields are moving, well, they're moving back up, and that might not necessarily be a bad thing for the basis trade. What you want to watch for in the treasuries is if we see a lot of volatility. If we see the yields moving up and down massively, that will be trouble for the market and the financial system. So back to where things are. What about gold and silver? Well, gold and silver were down quite a bit earlier on this morning. I checked them. But now they're almost back to unchanged. So they're doing quite well despite the weakness in the stock market. Gold is at $39.95. It's only down $5. Silver is down 15 cents at almost 48. We did get 47.50. So yeah, I expect actually gold and silver to do well despite the potential for a massive financial and banking crisis. Repo, another repo apocalypse. That's what we called it in 2019. And I'm going to urge you to look at my playlist about derivatives. I've put it up here, and I'm also going to put some videos I did in 2019 about the repo market. And I warned before everything took off. And the way to also know what's going on, whether there's problems there, is when the repo rate goes way above the Fed funds rate, which is at 3.75. And Zero Hedge notes that the repo rate yesterday jumped quite a lot, the most in many, many months. And it was akin to basically equivalent to the Fed not really cutting last week. So that's what's going on there. So yeah, hold on to your gold and silver, of course, real gold and silver outside the system for dear life. Miners, hold on to them as well. They'll be volatile, but if gold and silver continue going higher and provide safety from this mess, naturally the miners are going to do well too. And look out also for the Fed. They could announce the end of QT before December 1st. If they do, if they come out and say we're going to do it right now, then you know there's trouble. So I'm going to stop right here and wish you all a very good day. Take care. Bye.